We've all come to learn there are no guarantees in life, but one thing is definitely certain right now. It seems the cost of living continues to rise each day. Inflation, unemployment, and other global factors causing lots of financial concerns and confusions. So joining us this morning to help you stay fiscally fit during this very uncertain time is Timothy Baker with Metric Financial. Tim, thank you so much for being here. Really appreciate it.
Yeah, thanks for having me, Angela.
Of course. So I think the first thing people at home are wondering is what's really going on with the economy, because we keep hearing there might be a recession. Are we in a recession? Are we not in a recession? What's going on with that?
Yeah, so really the way we think about this at Metric Financial is we're still very much dealing with a hangover from not necessarily COVID, but the lockdowns that were put in place due to COVID. Excuse me, right? So you put everybody into a lockdown, people stopped driving, people stopped going to restaurants, and you had these massive changes in demand between technology and things that were not technology, right? Everybody wanted to use Netflix, but nobody was driving to the office or going to restaurants or taking cruises. So here you are 2 years later, all of that demand comes back and all of these companies are trying to ramp up their supply, which is harder to do because we also created a lot of incentives for people to either leave the workforce or just not join the workforce, right? All the welfare that went out in 2020. And so now with all the demand coming back, companies are struggling to up the supply, and that's causing massive price increases, or inflation as we call it. And the Federal Reserve, one of their two jobs is to control inflation. So that's really what they're trying to do by raising, rates.
And by doing that, by raising those interest rates, how does that actually reduce inflation?
Yeah, so this is actually really important. The Federal Reserve historically has only controlled short-term interest rates, overnight rates, the rates that banks charge each other for overnight loans. But if anybody's heard the term quantitative easing, that was basically the Federal Reserve's process of buying bonds, not just changing short-term rates, but buying bonds out in the market, which pushed interest rates, long-term interest rates lower. So now the Federal Reserve has had control over both short and long-term rates. So as they're controlling the cost of banks through those overnight loans, banks are passing those costs along to their customers. But as long-term interest rates are rising as well, you're getting very important changes to things like the housing market, which you can't really underestimate how huge real estate is as a percent of our economy. The simplest way to put it is the Federal Reserve is trying to put people out of work and kill the housing market because that's what's going to slow demand for everything.
So given this backdrop, what's your advice for investors? What should they be doing right now?
Yeah, the number one question we get is, we're going into a recession. Shouldn't I be getting out of my stocks? And there's a couple of things that we try to think about. Number one, stay focused on your time horizon. Timing the market is a very, very difficult thing to do. If you remember what happened in March of 2020, obviously the S&P 500 dropped about 35% in a little over a month and recovered that very, very quickly and was actually up about 16% by the end of the year. So trying to time these things is very difficult. The other thing I would say is folks should be very careful about equating recessions with stock market returns. If we go into a recession, the market's going to crash. There is very mixed data on how much the stock market actually has to do with the economy and vice versa. And there's also a lot of mixed data on when stocks will react to recessions and how much they will, right? So are we going into a recession? Are we already in one? It's very difficult to define, but did we already price that in with the S&P 500 going down 20% last year, right? So those are all things people should think about, and worrying about the day-to-day is just, I always tell people, go for a hike, turn off CNBC, right? There's no point in worrying about this stuff. The market has always recovered from crashes. 2008, COVID, the 2000 dot-com bust, and actually I put out a weekly report and I noted in there that if you look at where the market is, the bottom was in October of last year and we're up about 13.6% since then on the S&P.
Just got to take it day by day. Taking a hike, that's some good advice.